Let's get more on the markets. Our guest making his BNN Bloomberg debut, David Bahnsen, Chief Investment Officer at the Bahnsen Group. David, thank you very much indeed for coming on the show. Just tell us a bit about yourself. What is your shop? What do you actually do for investors?
Well, the Bahnsen Group is a private wealth firm, 10 offices here in the United States, and we manage $7.5 billion. And particularly focus on dividend growth investing, believe very strongly, and that is a core part of a client portfolio. Our U.S. equity is entirely dividend growth driven. And
certainly that, by many measures, has been a successful strategy over the years. Companies that pay a decent dividend and tend to increase it. You say we had, obviously, a roller coaster in April. There was something of a debacle after Trump announced his tariffs and then delayed them. But you say now we're into the period of consequences for the economy. Can you enlarge on that?
Yeah, I think that what you first and foremost get is a certain degree of uncertainty, and a lot of people are focusing on the uncertainty with the consumer. I think that's a mistake. Consumers generally will say that they're uncertain right before they go on spending money. The uncertainty that we're more concerned about is in production. We believe that you see it already in early innings of delays and cancellations in shipping and freight, cargo, ports. But fundamentally, there's just a significant decline in orders. And what that refers to is a lag effect of a decline in capital investment. So it puts a downward pressure on productivity, downward pressure on hiring, and I believe this is most intensified with small businesses, those with less than 250 employees, where 80% of the job openings in America are with smaller companies. So there's a real vulnerability in terms of macroeconomic impact.
That's interesting. I take it from that you would be wary, and I know it's a very broad group, but you'd be wary of stocks in the Russell 2000 then, smaller stocks?
No, because I don't think that the small Russell 2000 is small businesses per se. It's still capital markets. They're still publicly traded. The Russell 2000 has had a lot of problems for some time, mostly that about half of it doesn't make any money. And yet publicly traded small cap, actively managed where there's a bit more focus on quality, I would be a lot more sanguine on than just the broad index of the Russell. My concern on small size is more a comment on the impact to the economy, that there's a vulnerability with hiring, with wages, with productivity, if I'm right, that small businesses are taking the worst brunt of this trade war.
IBM, a venerable name in U.S. technology, that stock is up this year. The broad market is down. What attracts you to IBM?
It's a classic case of an old line business that is very cash flow generative, from which they get consistent dividend payments out to investors, but with new line growth opportunities. So they still have their old school businesses, and now they've become a major player in the hybrid cloud space. Their acquisition of Red Hat software is a recurring revenue business for them, in their case, blended to a consulting business. But then they have an AI business that is adding $1 billion a quarter, it looks like, to its new book of business. You look at what they're able to do with some growth engines, you get kind of a free call option. But in the meantime, we love the dividend and the free cash flow generation, somewhere around $13 billion of free cash flow they're going to generate. So IBM just is one of these rare companies that you're paying a kind of value stock multiple to potentially get a growth stock activity.
That's interesting, and the stock up almost 50% in the past year. Texas Instruments, a maker of specialty semiconductor devices, or they're not AI devices as such. What attracts you here?
Well, again, you don't have the same valuation issues that you have with other names in the semiconductor space. And you have a company that was ahead of itself, so it then came back in stock price, and you now got a better entry level from a valuation and multiple standpoint. But we think that the worst of their issues before, with a glut of inventory, a lot of their customers working through excess backlog, that there's now a cycle of new order. They have managed cash flow well, and they're just a great dividend grower, old school company as well. So there's a theme here that we don't want to pay up for new school technology companies that are trading at 80 times earnings. Texas Instruments is a really great story at an attractive valuation.
We're tight for time, but Brookfield Infrastructure, for one thing, much less tariff exposure.
Well, that's definitely true. It's also a 4.5% dividend yield at entry. They're growing it, and it's diversified in the business model. So you have data center, which is a more exciting infrastructure story, but you also have oil and gas pipelines. You have, a really strong core competency. Brookfield Infrastructure is a great company that isn't very well known here in America.
David, thank you very much indeed. It was great to have you join us on BNN Bloomberg. I hope you have the opportunity. I hope you have the time to come back soon. We'd love to get more from you. David Bahnsen, Chief Investment Officer at the Bahnsen Group. Up next.